Hi, our topic today is about bank reconciliation. Now, business normally will have a bank account with the bank because, for example, it likes to make payment to the supplier, then it will allow the business to be able to issue check. And then sometimes if the customer they want to make payment to the business, they can bank in directly to the business bank account. So often a business will need a bank account. Okay, so now a business bank account is maintained by both the business and the bank. Okay, so the bank will have a record, the business will also have a record. From the business side, they will record it in the bank account under the cash book, whereas for the bank, what they have done, okay, they will usually send out the bank statement to you, okay, to reflect the transaction that appears in your account, in your bank account with the bank, okay. So theoretically, the balance in the cash book should be the same as the balance in the bank statement because they are the same thing, right? But normally, they will differ. Why is that so? This is because there are certain items found in the cash book only but not in the bank statement, and vice versa, meaning the items found in the bank statement only but not in the cash book, okay? And this is due to possibly timing differences in recording or errors by one party, okay? The difference is mainly due to these two reasons, okay? If it's not timing difference, then it's normally caused by the errors by either of the party, either the business or the bank, okay? But normally it will be on the side of the business, but it could be on the bank as well, okay? So it's due to these two differences, okay? Mostly it's about the timing difference. Now, because of that, okay, because of the timing difference, we will need a bank reconciliation statement. That's where the bank reconciliation statements comes in. That's the purpose of this topic, okay? So what's the bank reconciliation purpose and what's the purpose, okay? So a bank reconciliation statement, okay, so I'll just write a statement. A bank reconciliation statement is a statement that reconciles the difference between the balance in the cash book and the bank statement to ensure that the differences is due to timing difference and not by errors, okay? So you need to reconcile, okay, to match up the difference between the cash book and the bank statement to make sure that the difference is due to the timing difference when you record the items, okay, and it's not by errors, okay. If it's by errors, then you need to correct the errors accordingly, okay. And then if it's after you reconcile, then you find out that the difference is due to timing difference, then it's okay, okay. Check for fraud as difference in the two records are compared and reconciled. Okay, you can check for fraud because the two statements are being compared, and enable the cash book to be fully updated at monthly intervals, okay, by including the transaction undertaken automatically by the bank, okay. So you update the cash book with the items that's not in the cash book yet, okay, it has been reflected in the bank statement but not yet in the cash book, so you include those inside the updated cash book or the adjusted cash book. So these are the brief definition before we go to the other details. So bank statement is a statement or a summary of transaction that have taken place in the business bank account sent at regular intervals, normally monthly by the bank. A bank overdraft is when a business paid in excess of what it has in the bank account. Okay, this is a facility applied with the bank. Okay, for example, the business have currently 10,000 in the business current account, but it draws up a check of 15,000, or maybe that's still okay because it has a bank overdraft facility with the bank of 5,000 maybe. Okay, the drawer or the payer is the person writing the check and using it for payment. The drawee is the bank on which the check is being drawn, the bank, okay. Payee is the person to whom a check is paid, okay. For example, the business paid to Ali, then Ali is the payee. Now, the cause of difference in the balance of the cash book and the bank statement. So as we already mentioned here, the difference is either by the timing difference or due to errors. Okay, so now what are the items found only in the cash book, and these are the items found only in the bank statement. Okay, now over here there's one very important point to take note is that you need to remember that the business and the bank, remember here, the business and the bank, they take a different point of view. Okay, for the business, okay, which we record in the bank account, okay, here on the debit side is deposit, okay, meaning money coming in, and on the credit side is withdrawal, okay, or meaning money going out. Okay, however, for the bank is opposite view. Okay, when we deposit money into the bank, okay, it will appears on the credit side. You see here, for us the deposit is in the debit side, but when we deposit money on the bank, it will appears on the bank at the credit side. This is because when we deposit money to the bank, we are now just like the bank creditor already, because the bank, when we deposit the money to the bank will owe us the money. Okay, so we are just like the bank creditor. Okay, because the money belong to the to us, the business. Okay, that's why deposit money coming in the bank account will be on the debit side, but money coming into our bank account at the bank side, okay, from the bank side, they will record it on the credit side. Okay, and the same for withdrawal. So for our bank account, when we minus, we put it in the credit side, but on the banks, they will put it in the debit side. Okay, so this is a very important point to take note. More on that later. Okay, so now what are the items found only in the cash book, okay, but not yet in the bank statement? So this is it. Okay, so the debit entry, uncredited check. So here, these items, if there's an item here, okay, but it's not in the bank statement, this is called the uncredited check. Okay, check deposited but not yet clear or credited. As you can see, when we deposit the money in, but the bank is on the credit side. Okay, we debit, but the bank is on the credit side. So the money deposited, the check deposited into our bank account, but not yet clear by the bank. Okay, for example, a person deposit the money into our bank account using the ATM late at Saturday night, but the bank is not open on Sunday. That's why this check is not yet credited. Okay, so this is not yet appear to the bank statement. Okay, so this one appear already. We in our bank account we already put increase, but it's not yet appear in the bank statement. Okay, now withdrawal. Okay, unpresented check, check issue but not yet presented for payment at the bank. Okay, so for our bank account here, for example, we make a payment 100, okay, 100 here, and we give it to a customer. Okay, but a customer, so we record this in our bank account minus 100 check. Okay, but the customer probably he's too busy, so he does not have the time to go to the bank yet. Okay, to collect his money. That's why this one, okay, is called unpresented check. Okay, we have already minus off the amount, but it's not yet appearing on the debit side of our bank statement. Okay, because he has not presented it to the bank. Okay, or the bank have not debited it yet in our bank. Debited it from our bank account. Okay, so these are the two scenarios for the items found only in the cash book. Now, what are the items found only in the bank statement? Okay, so as we say already, what is plus for us will be on the credit side, and what's minus for us, like normally when we make payment, all that will be for the bank, it will be on the debit side. Okay, so all these minus, you see, for example, minus in our bank account is bank charges. Okay, so charges, because minus, okay, it will be on the debit side. So bank charges by the bank, okay, for the service, for example, commission for checkbook, interest on overdrawn account, okay, you have overdrawn more than you have in the account, standing instruction and direct debit. Okay, these two are a little bit kind of same but different. Okay, they are payment made directly by the bank, okay, on the business behalf, but the difference is that standing instruction, they pay a fixed amount at a given date. For example, every 30 of the month, they pay 150 for the business insurance. Monthly, they pay 150 on the 30th of every month. Direct debit is also instruction given to bank to make direct payment from the bank account, but the difference is that direct debit is varying amount, different amount. Okay, so it can be making payment to this company, this month is 120, next month is 50, and so on. It's a varying amount. Okay, so he gives the bank the authorization to make payment from his account to this other party. Okay, a varying amount. And then this owner check is the check that's not honored by the bank. Okay, bounce back. Okay, it's not being honored. That's why we have to minus off from our bank account. And deposit is our money, okay, increase our bank account. Okay, so for example, credit transfer, or we call it direct deposit, when the customer deposit the money directly into our bank account, into the business bank account. Bank interest on deposit, for example, we have a deposit and the bank give us the interest on the deposit, so it will is a plus for our bank account, and dividend deposited directly into the bank account. Okay, so this is like the receipt. Okay, plus on the credit side. Oh, what is this? Let me erase this one first. This is the same. Okay, now so this is the background information about this topic. So now to reconcile the difference between the cash book, bank account, and the bank statement, okay, we need to do it in 2 steps. Okay, the first one, okay, so what is in the bank statement only but not in the cash book, we need to put it in the cash book. Okay, so as you can see here, all the debit entries in the bank will be the same as all the credit entries in our cash book. Okay, because remember, the cash book and the bank take an opposite point of view. So what is debit here will be here on the credit. Okay, plus on the debit, but here plus is on the credit. So here, this is in the bank statement only, we need to put it in the cash book, okay, to reconcile the difference. Okay, so what's minus, we will put it in the cash book on the credit side. Okay, what's plus, we will put it in the cash book on the debit side. Okay, so first of all, we reconcile. So the items in the bank statement, you have to put it in the cash book, okay, to adjust the cash book and bring it up to date. Okay, so when you see the items appear in the credit side, you put it in the debit column, and if it's in the debit column of the bank statement, you put it on the credit. Okay, this is the first step. The next step, you have to put the cash book to reconcile with the bank statement. So whatever in the cash book but not in the bank statement, you have to put it into the bank statement. So we open out a bank reconciliation statement. So the bank statement will have a credit balance, okay? So the bank statement will have a credit balance. Okay, so these items are not in the bank statement. So credit balance, so we for example, this one debit, right? We'll put it on the credit side. So we have to add uncredited check. We have to add uncredited check and minus unpresented check. Okay. Oops. And minus unpresented check. Okay. So for example, this one, you see, we already minus off, right? But it's not yet appearing in the bank statement. That's why on the bank statement, you have to put it on the debit side. Okay, on the debit side, unpresented check. So you see, this is debit side. And this one already we put it in our bank account, but it's not yet in the bank, right? So we have to add it to our bank. So deposit increase in our bank, on the bank side is the credit. Okay. So that's part 1 for today. We'll continue the next lesson.